On the 28th of April 2026, the UAE announced it was leaving OPEC, the oil cartel it had been a member of since 1967. Within hours, Brent could hit 113 a barrel and WTI crossed 111. This briefing breaks down exactly why that happened, what the UAE exit means for global oil markets, and what every Kenyan is going to feel at the pump. To understand the price spike, you first need to understand the Strait of Hormuz. This is a narrow channel, just 33 kilometers at its tightest navigable point, sitting between Iran and the Arabian Peninsula. Every single day, roughly 17 million barrels of oil pass through it. That's about 20% of the entire world's oil supply, moving through one bottleneck with zero viable alternatives. There is no other route at scale. Since late 2025, Iran has been firing missiles and drones at commercial tankers in and around the strait. Insurance costs for ships transiting Hormuz have already surged 400%. The UAE itself relies on Hormuz to export its oil, and Iran attacks are the direct reasons for the UAE decided to walk out. So here is the sequence of events. Late 2025, even before the war started, Iran starts targeting Gulf shipping. February 2026, attacks escalate and UAE exports are disrupted for the very first time. The UAE goes to OPEC and asks for quota flexibility so it can reroute exports. OPEC says no. April 28th, the UAE walks out, effective 1st of May. By leaving the UAE, it gains the freedom to pump as much as it wants. It can sign direct supply deals with Western buyers, and it sends a clear geopolitical signal of where it stands. But here is the irony. It still ships most of its oil through Hormuz. Leaving OPEC doesn't protect its tankers from a single Iranian missile. This exit is as much a political statement as it is an economic one. Now, here is a question everyone is asking. If the UAE is leaving OPEC to pump more oil, shouldn't prices go down? In normal times, yes. More supply means lower prices. The UAE could add 400,000 barrels per day global oil markets. That's bearish. But here is a paradox. Oil markets don't just price what's happening today. They price risk. And the risk on the table is a full closure of the Strait of Hormuz. 1 week of Hormuz being shut down removes roughly 120 million barrels from the global markets. Compare that to UAE's extra 400,000 barrels per day. It's not even close. The fear of losing Hormuz completely overwhelms the benefit of UAE's extra supply. That Hormuz fear premium alone is worth somewhere between $15 and $20 per barrel right now. Fear wins, and that's the reason why prices have gone up. So what does this mean for the fuel in Kenya? What does it mean? So if you remember, EPRA took the prices up to 197 last month. The price then was 93 per barrel, and the exchange rate was 130. Assuming everything else remains the same, the price is going to move to 212. And here is the analysis. So at 111, raw crude becomes 90. And if the stabilization subsidy stays the same, then the government is going to be paying 4 shillings. and therefore the price now moves to 212. If they want the price to remain at the same level as this has to go up to 15 shillings. Now, they collect 5 shillings for the fund. So the maximum they can subsidize is 5 shillings. They're already at 4. The VAT is already at 8%. So in order for them to be able to maintain this, to be able to take in this pain on your behalf, then they have to start touching the other lines, which is the road, the petroleum levy, which is 25 shillings. Because remember, they collect about 72 in total from you. But it will be interesting to see if they actually give in to and start collecting from the other lines to subsidize fuel more. Or they have an option to eliminate those taxes altogether, because they have 72 here to be able to cushion. Otherwise, if they don't do that, then energy prices are going to go up as they have, and inflation is going to go up. So it's going to start a very bad chain reaction.